And we are live today, Wednesday, special edition of Livestream Wednesday. Was going to do it yesterday, but with the Memorial Day weekend, I figured it would be more useful to have, these glasses on. Well, no, more useful for you if I gave it a day. That way we'd at least have a day's worth of market trading and some information to come out, because oftentimes after the Memorial Day weekend, it takes a little bit to get into sync to see what is going on. And so for today's live stream, we have a packed agenda. Packed agenda. Want to cover some macro. Want to show you some of the things that I look at, on a day-to-day basis. Be like, where's the market going? What is it doing? Why is it doing what it's doing? Where, the most important thing, of course, is like, where are we going? Where are we going? Because you want to set yourself up, obviously, for where the market is going. All right. But before I do that, I'm going to take off my matching glasses. I hope all of you like my effort to keep you entertained, with obviously information, but also visually. All right. Let's do all the usual legal stuff, which is that this live stream and the content from ATG Digital Media is not investment or financial advice. It's presented to you as opinion, information, engagement, and entertainment. Yes, entertainment. Next, all ATG Digital content may contain errors, oversights, and or mistakes. Understand that investment operations, what is that? Buying, selling a stock, crypto, option trading, have significant risks and can lead to the loss of your principal. Bottom line, you could lose money. Also, the owners, employees, contractors, own, trade, transact in the securities I mentioned in this video, and all content from ATG Digital Media. We do not take money from companies or crypto promoters or people who do that stuff to recommend their stocks or crypto tokens. For better, for worse, for wrong, for right, everything is based on our understanding of the facts, our research, our experience in the world. We put out a lot of content, free Substack weekdays, Ballman Speculating podcasts between 2 to 3 times a month. Obviously, I'm on YouTube quite a bit. Social media, very active on X, previously Twitter, Instagram from time to time, Facebook. Dean is pretty active there in my name. If you are interested in subscriptions, would begin at $9.99 per month. All right. Today I'm going to share like a bunch of things that I look at on a day-to-day basis, because having done this for 30 years, wow, like 30 years, you can always have a sense for like what people are feeling, sensing, and what's going on. And I was doing the silver tier update for ATG Digital Media. Silver tier is our introductory portfolio, has large-ish companies, mid-ish companies, and a tiny number of small companies. And just going through the review, because I sort of like, I look through the charts, I look to see, well, what their earnings have been. I look to see what, social media is saying about these companies. And, the one thing that it struck me was that people just seemed like kind of blah. I mean, maybe it's the post-holiday thing, but essentially there was, as far as I could see, excitement about one thing. Yeah, and that was about AI and about one stock in AI, and that was NVIDIA. And other than that, everybody was just like, I mean, there's always a little bit of excitement around Bitcoin. Those folks are on social media pretty much all the time. And with the Ethereum ETF, there's like, a little tiny bit of excitement in crypto land. And then there's always stuff going on about Tesla. But other than that, there's just not a whole lot going on. So today I just want to show you like, hey, some of the things that I don't know if you'll find it useful. I find it useful to sort of go and look at these things and just give you a macro perspective of like, what is going on in the world? Why are things the way that they are? And then why, in my judgment, and you'll see this from one of the charts, just that, it, yeah, I mean, I've been saying this for a while, which is that opportunities don't just happen, in a heartbeat. However, the biggest opportunities generally happen after a period when things are sort of like sitting in a particular position, and then they just erupt out because oftentimes people understood the opportunity, but they got bored. And so they sold out and they got out. But let's just start with like a general macro overview. So, what are we looking at here? All right. This is arguably, at least in terms of the economy, in terms of the market, sort of like the most important thing. One of my old mentors used to say that, interest rates are to the financial system as gravity is to physics. Gravity, as you know, I mean, if you throw something up into the air, is guaranteed to come down. Why? Because gravity, you can't escape it. And interest rates act in the same way, which is that interest rates are critical to our economy. Pretty much every company on earth, in some way, shape, or form, depends on it. If you have debt, obviously the cost of debt is denominated in interest rates. If you have a lot of savings, I mean, well, then you earn interest in interest rates. And what are we looking at here? Well, this is the 3-month US Treasury interest rate, and it more or less mirrors what the Federal Reserve sort of controls. And you will see that starting about 2022, this very short-term rate just started to go up and 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 go up. And then for what? About the last about a year and a half, it's flatlined. It's flatlined. And what has the commentary and what has been the narrative that's gone on with this as this has happened? Well, into the rise, where it goes from like 2022, what was happening is this: inflation was rocketing higher. The Federal Reserve completely did a 180, said, well, we're considering interest rates, lifting interest rates, and then they lifted interest rates essentially from like, look, I mean, zero, negative even percent, all the way up to about 5.35%, which is the fastest increase, I believe, is since the Federal Reserve became a thing. So they went from saying, yeah, we're not really planning to do anything, to lifting interest rates by 5%, which is a big jump, right? And obviously, if you've been in the kinds of stocks that we focus on ATG Digital, what it has meant is that somewhere around 2021, pretty much all of the innovation sort of stocks, growth stocks, opportunity stocks kind of peaked. Some of them have come back a little bit, but for the most part, we're still more or less where we were. I mean, we haven't seen new highs anytime recently. All right, I'm going to skip through some of these charts, but I'll come back to some of them. But effectively, we live in this land here. And what does this chart show? I mean, essentially, well, the red line is the same interest rate that I showed you earlier in the previous chart, which is the 3-month US Treasury yield. And this is a proxy, meaning that a substitute or a way of tracking both interest rate expectations, kind of like what there's buying and selling that goes on of T-bills. And so this kind of tells you what traders and what investors and what sophisticated big money is doing around, because if everybody comes to buy US Treasury bills, then the interest rate would go down. If everyone goes to sell, it would spike up. So, I mean, these kind of track expectations what's going on. And then the other ones are various different ETFs to make a point, which is that pretty much since the Federal Reserve lifted interest rates and interest rates went up, we have had a bifurcated market. What is bifurcated? Well, big word that means a two-way market. Big investors, because it is their movements that cause prices to move higher or lower. When people come in and start to buy, that demand pressure pushes prices higher. When they come to sell, that selling pressure pushes prices lower. So if you look at this, well, starting about 2021, the purple line and the green line are what would be called long duration investments. Long duration investments means that the biggest payoff is out into the future. So, for example, the green line there is for the 30-year, it's supposed to track the 30-year US Treasury bond, right? And the purple line there is the ARK Innovation ETF. Now, you might be thinking, well, how could those two things be the same? How in the world can you compare these two things? Well, in the way that the world of finance operates, right? A company is ultimately just a tally of its future cash flows. And if you are an innovation company, a growth company, a young company, your peak cash flow, your peak sales, your peak profits are much further out into the future than a more mature company that, yeah, has seen its fastest growth, it's commercially mature, they have fairly steady profits. Maybe they have very reliable cash flows so they can have dividends and they can stack cash and all these things. But young companies are in a very different position. Their future peak cash flows might be 15 years out in the future, might be 20 years out in the future, might be 30 years out in the future, no different than like a 30-year bond. If you buy a 30-year bond, when are you getting the biggest slug of money back? Well, you get small bits of interest along the way, but you get the biggest slug of money back, which is your principal back in in 30 years. So this is how they're comparable in the sense that these are long duration investments. And the general idea is that when inflation is rising, future cash flows are worth less than present cash flows. Equally, when interest rates go up, the way that future cash flows are sort of like evaluated, they say discounted, is such that high interest rates mean generally lower values, lower interest rates mean generally higher values. So given all of that understanding, you can kind of like see like, well, what the market has bet on and what it has done since 2021. Since inflation started rising, the Federal Reserve started lifting interest rates, we have a bifurcated market. Short-term based investments like the S&P 500, which is dominated by mostly very large companies, very mature companies, companies that relative certainly to growth and innovation have much more predictable cash flows. And most importantly, and their peak cash flows, their peak sales, their peak growth is, I don't know, maybe 3 years away, maybe 5 years away. They're not going to see gigantic rises. Why? Because, well, I mean, they've gone through their sort of like enormous growth spurt. But our companies, yeah, that may be 10 years old, 12 years old. Yeah, I mean, their biggest sales are minimum 3, 5 years out, if not much further than that. I mean, they are just really beginning some of the biggest growth phases that are out there. So this is where we are today. We continue to sit in this place where essentially the big companies in the market are where like all the investors have pretty much put all their money. And our companies essentially are not getting investor funds. And why? Well, I mean, because I think that even though inflation has moderated a great deal from when the Federal Reserve was lifting interest rates, it's estimated to be around 2.7%. We still haven't gone back to 2019, and interest rates are obviously at 5%. Now, there are any number of things that are going on with our stocks that at present, are not recognized in stock price. The managements of the companies of growth and of growth companies, innovation companies, as interest rates started to go up, they realized that the low interest rate party, the zero interest rate party was over. From now on, they could not focus on pretty much any opportunity that they wanted. They have to focus on opportunities that generate cash flow, that generate profits, and they've pivoted. At the same time, legacy companies, which are again the biggest companies in the S&P 500, they've benefited from rising inflation and they've lifted price. For the most part, our companies, well, I mean, they have new technologies, and the general idea is that, well, you implement us and you save money. So they haven't necessarily benefited from inflation. Now, this benefit from inflation from the bigger companies, yeah, I mean, that benefit has pretty much run out. And you can kind of tell that by the fact that, yeah, the old school companies, the legacy companies, they're struggling to lift price. They can't lift prices anymore. And that's one of the reasons why their profits and their sales have surged. Instead, everyone now is like, oh, we can't lift price. We either need to cut costs, we need to implement something, some new technology that will cut things. And that is to the benefit of, like, yeah, our companies, because our companies make these innovations, make all of these things that can reduce costs, that can increase efficiencies, that can make you far more productive. And at the same time, on a macro basis, yeah, the economy is slowing. We're seeing that in the housing market. There are some really weird juxtapositions going on. Like, for example, existing home sales have pretty much collapsed, but housing prices are making a new high. Car inventories are surging higher, but yet car prices have not come down and used car prices are soaring. So there are all these like cross currents going on that eventually point to like, well, the essence of all of the problems is that like the prices of many things have jumped, and either those prices have to come down or incomes have to go up. And it all generally means one thing, which is that sooner rather than later, the economy is either going to slow enough where it will bring inflation down a little bit lower. And at that point, no one is really expecting any more for interest rates to be cut, but people got very enthusiastic about it about a few months ago, but the economy is now actually slowing. Yeah, housing and cars represent the largest part of the legacy incumbent economy, which means that somewhere in the next 3 to 6 months, that red line, I'm going to scroll back up, that red line is going to go, I don't know, it's definitely not going to go back to, it's not going to go back to zero. It's not going to go back to, I don't know, 1%, but I expect it will go back to something like 3% or something like that. And that is going to be a fairly large bump for our companies because that means that inflation is lower, which means people modeling innovation and growth companies be like, oh, future cash flows now are worth more. The discount rate, which is the interest rate, will be 2% lower. And at the same time, our companies are much more profitable. They've also been growing for 2 or 3 years. I'm just going to show you a chart of, let's see, like a company like yeah, Chewy reported today, and let's just look at what Chewy's numbers are. I'm just going to share this tab instead, and you can see that Chewy stock is up today. Why? Because, well, I mean, clearly investors have been thinking that this is a company that was never going to grow again. But this chart, which maps a few different things, it's quite a lot going on. It's not the best display in the world, but this is a platform called Y Charts, which I use all the time. But that blue line here, that's associated with 10.44 increase. So that is Chewy's growth for 2024, 10% growth. Doesn't sound great, but I can tell you that into 2024, 10% is going to seem increasingly like a very big number, because if you don't have inflation going your way and you can't lift prices and the amount that people buy is not increasing, and there's a good reason why it's not increasing, because prices are higher. Generally, as prices are higher, people can afford less and less. So it generally benefits the one that can offer you a really good value proposition, something about whatever the business is better. And they're up 10%, but you can see that because we've been in a 3-year bear market, that the analysts and everybody, they're not very optimistic. How do we know that? Because you look at this orange line, and that is next year's 2025, the estimates for next year. People are like, yeah, okay, 2024 is coming a little better, but like, Chewy's done nothing for a while. So I have read lots of research and and looked at this. Generally, the crazy thing is that forecasts follow prices. So in other words, while we look at forecasts, etc., only the very short-term forecasts sort of like really indicate like the sentiment, which means that stocks like Chewy, which has just been smashed. I mean, it was what, at 200, and now it's it's up a little bit today, but it's up nothing. It's still the dominant online platform for pet supplies. And my best guess is that, I don't know, you talk to the average person, a ton of people use Chewy. So if I'm right, in the next 6 to 12 months, you are going to see a lot of factors go correctly, not just for Chewy. And you're thinking, well, but Paul, Pet Supplies is not some like innovative company. Yeah, I mean, Chewy is like the Amazon of pet supplies. They are the default option for so many people, and they are definitely a technology company, because while they're in the pet supply business, just like Amazon is in the pretty much everything business, it's built on a technology platform. That's what gives them their leverage. That's what gives them the ability to implement whatever it might be, artificial intelligence or some robotics, to be able to reduce prices. And that then allows them to pass that on to the consumers, which then drives market share. But if I'm right, you're going to have everything go the right way. This orange line, is going to it's not going to stay at negative 1.5%. You'll see that like as the stock price starts to improve, people will start to lift their forecasts, and suddenly we'll be at 12 or 15% growth. And with that, Chewy stock will start to keep running higher. Why? Because investors will come in and start to bid it higher. And we are going to see more and more and more of this. I'm just using Chewy as an example. All right. Let me get off here and talk about sort of like the basic premise of this live stream, which is that at low prices, we are generally unenthusiastic, uneuphoric, uninterested, and increasingly we want to sell. We want to sell, right? Because I can tell you whatever it is about any company. I can show you the best financials in the world, whatever. But if the stock price is not going up, there's no benefit to you, right? But you have to juxtapose that against the fact that, well, if you want the biggest gains, you have to be in at the low prices. But there's no benefit to being in stocks at low prices unless you are patient and willing to wait. And that's kind of like where we are now. I mean, one of the things that I've been saying in my ATG updates is that the world isn't going backwards, right? I mean, it's not like we are going to go backwards to where like, okay, we're going to go back to, I mean, I know some people expect this, but we're going to have no EVs. We're not going to have self-driving. We're not going to have drugs that, increasingly have a chance to, cure cancer. We're not going to suddenly go back to like, okay, shut down all the online stores and only have on-premise shopping. Or we're going to, turn back the clock and go back to, it's like, well, forget banking online or thing. The world keeps going forward. And if that's correct, then it's inevitable in some way, shape, or form that the companies that represent the future are going to capture the market capitalization of the world. The current sort of like setup where about 100 companies in the S&P 500, right, represent 70% of all of the value of the S&P 500 companies, right? So we've got 500 companies in the S&P 500, and the top 100 represents 70% of it. This is an extraordinary extreme. And, it's not, it's even much worse than that, because the top 7, which is all the usual suspects, Apple, Amazon, Microsoft, Google, NVIDIA, Meta, and I think Tesla has fallen out. I think Tesla is not even in the top 7 anymore. But Tesla is different. I mean, its stock has not done anything. Its stock, in fact, has gone the reverse way, which will tell you in which category that is, which is like it's being treated like a growth stock, etc. But the others are all being treated as short duration, sort of like investments. And if I'm right, we're going to see a shift. In other words, going back to the chart that I was telling you, where prices have gone one way for one set of investments and the other way for, so this chart is going to reverse, if I'm right. In other words, you're going to see, yeah, long-term bond prices go up. You're going to see innovation and growth stocks go up, and you will see the other track down. In other words, so we will see a reversal of this process as the macro conditions sort of support opportunity, growth, investment, innovation and crypto. And it will be unexpected because, yeah, I mean, where are people today? Well, people are generally where high prices are. Why? Because it feels comfortable, it feels right, there's a current reward, it makes you feel good. Other people are also doing it. You can, you don't, you're very comfortable and feels very good. But generally, to make a big return, to have large returns, you have to be doing something. You can't be in what everybody else is, because the way to generate returns is that you've got to have other people come and bid what you own higher, right? And okay, I mean, where can Apple go? Can Apple go from 2 trillion to 10 trillion? Well, they have no growth. They haven't had any growth for several years. Pretty much their stock has been supported by buybacks. Can Microsoft go from, I don't know, 2 trillion to 10 trillion? Maybe, but their growth is deeply tied, despite what people say, to the PC market, and PC market has been in decline. Bottom line, we're sitting at a point where there's going to be a reversal, and is going to be unexpected, and very few people are going to participate because you don't get low prices like what we are seeing for our stocks because people are buying. We don't get low prices because people have held. We don't get low prices because people are optimistic. We don't get low prices because multiples are higher and things like that. We get low prices because expectations have crashed, sentiment has crashed, prices are low, and people are like, yeah, take my stock, take it. I'm so tired. I'm so tired of it. So if you're looking for future big returns, it's only going to come from the future. It's not going to come from companies that have been around for 50 years. Those are short duration investments. Their peak growth, their peak sales, their peak profits. Yeah, I mean, I'm sure there might be a minor peak additionally from here, but to make big money, you've got to be in the thing that, like, yeah, looking back in 5 years, in 7 years, you're like, oh, I mean, that's what I wanted to be in, right? And then now you get the benefit of big gains. So we are sitting at a time when there is, in my judgment, in my opinion, a lot of pessimism about the future, a lot of pessimism about these innovation companies that yet, this is where the growth is. This is where, I mean, if you're looking at economic phenomena like reshoring, what's reshoring? Well, for the better part of 20 something years, we pretty much shipped our manufacturing base over to China and to other places like that. COVID taught us that that was a terrible idea because we had all these supply chain effects. We couldn't get basic parts for all kinds of things. We're like, okay, that was not such a great idea. So we've started to move production back to the United States. What is that going to flow through? I mean, is that's going to flow through modern ways of making things, right? I mean, what's the modern way to make things? 3D printing, using lasers, all of these things that represent the future. Like, yeah, so there's no way to move production back from China and where we're going to put up some sort of like really old school production manufacturing capabilities. I mean, that's crazy. I mean, obviously we have to put some of that up, but a lot of it is also just going to take a different form, which is then going to drive a lot of different changes. So that entire change part of the economy is currently trading for almost nothing. How do we know that? Because I told you, go look in the S&P 500, the top 100 companies, which are pretty much filled with other than Tesla and a few others, are filled with non-innovation companies, non-growth companies, non-opportunity companies. That's where, yeah, the market capitalization, the value of the company is, and we are going to see like a reversal. And the reversal is, in my opinion, is setting up for the second half of this year. I've been through moments like this. It always feels like a little bit like, I mean, and you have to go a little bit by your feel and sense, but it will happen. And as it happens, it will just rocket things up, and people will be like, I don't understand what's going on. Why are these companies? But that's the nature of markets. And that's, how I believe, and in my opinion, things are going to go. Now, we within our companies, we can see movement of some people betting on like the things that where it's become clear. Like, for example, within the growth, opportunity growth, innovation, crypto sector, we can see like some of the buyers showing their hands. Remember, I mean, like while people think that stock prices are sort of like, they have their own personality, that like, they're holding their own, they're resilient, they're rocketing higher. The truth is that the market is a mix of manipulation, the market is a mix of orchestration, the market is a mix of actual demand, and a reflection periodically of actual value. But one of the things that you look at is that the charts you look at, price charts you look at, I mean, they reflect movement of prices, some of which is an orchestration, a manipulation to get you to do something or to get somebody else to do something. But if you're looking at company values, you're looking at prices, sometimes it's also just people showing their hand. Why? Because they're so enthusiastic, they're not willing to sort of like hide their buying. They kind of be, they're calling in their orders, or they're entering their orders in such quantity that you are seeing that impact on price actually in the marketplace. Right. And where are we seeing this? In my judgment, in my opinion, well, in crypto, we're seeing this for sure. Coinbase stock, I mean, I can't remember. It was what, at 80 or something? I mean, 40 or 50, just literally like 6, 8 months ago. It's now at 200. Why? Well, it's very clear. Bitcoin prices have gone up. This is a new category of investment. It's a new category of speculation. It's a new category of trading. So, yeah, their peak. I mean, where is Coinbase's peak trading volume going to be? It's not in the past. I mean, some people may think that, but this is a new category of thing. I mean, essentially, Bitcoin comes about in 2009. So, using Coinbase as an example, yeah, their peak growth, their peak sales, their peak profits are probably 30 years out. Now, I'm not saying you need to wait 30 years to make big money, but my point is that going back to the construction of what I was saying, we need for our stocks to go up. As interest rates get cut, um, as inflation goes lower, the value of all of those cash flows that come about as trading just rockets higher, in Coinbase, as people come to buy, whether it be Bitcoin, whether it be Ethereum, whether it be decentralized finance coins, whatever. Yeah, their trading is going to surge higher in so by like multiples of where it's been in the past. Where can Coinbase go in this scenario? Well, I mean, remember, Coinbase is a digital company. And while we think of them as being like Bitcoin, etc., essentially it's a very large computer that processes trade. It's a fixed cost. As trading goes up, they make money from fees. They make money from bid-ask spreads. They can make money from new businesses that they create, which still largely have a fixed cost. Right. And how do I know this? Well, I mean, in one of my old hedge fund companies, we were big investors in all of the analog legacy like exchanges, like the New York Stock Exchange. So we got to see like, an exchange driven by volume. I mean, their costs were much larger because they have to, they were built on sort of like old school technologies. But Coinbase is built on like, yeah, new technology. They're going to be way more profitable, way more efficient. So we can, and clearly smart investors that understand like, okay, how the market works, and you don't focus purely on price in the real term, because yeah, you want to invest for like, 3 years out, 5 years out, looking backward. because to get the benefit of the game now, you need to buy something that's cheap today, that's low today, where, yeah, I mean, the market is not focused at the moment, but this is where the big gains are going to be. So momentum, we can definitely see it in Coinbase, we can see it in Robinhood, we can see it in MicroStrategy. And I talked about this obviously last week in the crypto. Another place which kind of surprised me, where we're seeing this, is in new energy. And we recently put Enphase into the silver tier portfolio. Sunrun we put into the gold tier portfolio. Plug we put into the silver tier portfolio. And there are others. You can look at the TAN ETF. I mean, you can see it's bottomed out. Why? Well, I mean, it's become pretty clear, like, there is an enormous transition that is going on between legacy energy, oil and gas, and two new forms of energy. And that's primarily solar, then there's wind, then there's various other distributed energy resources, then there's batteries, and then there is software that has to coordinate all of these things. Now, I didn't put every single stock up there, but these are some of the stocks where we're seeing the buyers show their hand. In other words, they want in on these stocks, like right now, that they are willing to put large orders in that move the prices higher. And as that happens, you go like, why is this like stock, which, was down, was being bid down, sold down 50, 70%. Why are people coming in to buy this, right? Because they're businesses which are cyclical. Most people are like, I don't want to own this, but we have seen, like, if you're tracking the sector, we've seen like big financing transactions. Like somebody gave, Plug just got, I think it was a $1.5 billion loan. There's this much smaller company that I've talked about called SunPower that is in our diamond tier. They had Norway's largest energy company give them, I think, like $400 million. I mean, why would they do this? And the reason is that they understand something that people who are purely focused on very short-term trading don't really look at, which is like, we all want, retail investors, new investors, we want our gains like right now. We want to see our accounts go up. But larger investors they can be patient. And they know the biggest gains come from, like, yeah, you set yourself up now for that. But these are two places where you can definitely see signs of buying going on. Where are we seeing signs of like a bottoming out process? In other words, there's lows being made as clearly short-term investors keep selling down, even though they all get on some level that, look, if I can push my timeframes out by whatever, 1 year or 2 years, it's almost certain, given the direction of the world, we are not going to have less molecular diagnostics in our healthcare. We're going to have more. We have an enormous shortage of medical personnel. And what is the solution? Can we suddenly increase the supply of doctors? Can we suddenly increase the supply of surgeons? Can we suddenly increase, the supply of even nurses or physician assistants? We can't. All we can really do is say, well, what tools do we have at our disposal, right? And can we implement to solve the problem? What tools do we have? Well, one of the ways where it's been proven that we can increase the productivity of the healthcare system is by implementing online care. We know it works. How do we know it works? Well, we implemented it in 2020 when we locked the world down. And 60+% of all Medicare patients went through online. Now, obviously, as the world has opened up, the growth rate has declined, but try getting an appointment with anybody. For me to get an appointment with my primary care physician, I have to be like 3 to 4 months out. For a specialist, for anything, it's something similar. How do you break up this logjam? Well, it's going to have to be by doing something different. And what is something different? We can't scale up in terms of human personnel, so that's out. But one thing we can do is look at, like, okay, can these technologies in some way help make us more efficient? But at this moment today, because of, I think, people's hyper focus on the recent past, which is like, well, I want to be in computer technology stocks. My best guess is that the vast majority of people want to ask questions like about some stock that has seen some big growth rate in the last, I don't know, 3 to 5 years, it's AI. Very few people are going to ask about something into the future, which is like, hey, these prices are low, but like, look at the prospects for these technology. So, I mean, like Exact Sciences down 5% today. Illumina gotten smashed over the last 3 years. Teladoc, same thing. CRISPR, I can, run it out. But these are bottoming out, what I call buy low, buy slow, like, places, digital industrials, like 3D printing, lasers. There's a company called IPG Photonics, which we put back into gold here. Bottom line, we're at a critical point where future reality and current reality are going to diverge, and you will need to be positioned correctly for it. Right now, the vast majority of the market capitalization of stocks are in backward-looking companies for the most part, and so it's very extreme. And these extremes resolve in some sort of like violent fashion, or some very unexpected way. And that is what I expect to happen second half of 2024 and for the next 2 or 3 years, where people will look back at this period and be like, oh my God, Paul, those stocks were so cheap and it was so obvious. It was so clear. It was so clear. All right, I'm going to end my comments here, and I'll take some questions and see what folks have to say. So throw your questions into the comments, and I will try and answer them as best as I can. John says, hey, Paul, hope all is well. Like the latest assessment on Unity, the new CEO going through reset. Yeah, this is an example of what I was talking about, which is that Unity software, when interest rates were very low, near zero, it made sense for them to go after pretty much every single opportunity. But at interest rates at 5%, there is a cost to capital. You can't pursue every single growth opportunity. You need to be like, okay, this is my focus market or focus markets. And this is what, my personnel has to be organized to address those markets. These are the customers that pay us. These are the customers that are profitable for us to have and pursue. And then there are all these other things that we took on because for 16 years, interest rates were zero. The cost of capital was zero. And investors rewarded us both in private markets and in public markets to pretty much pursue growth at any price. That is no longer true. So they're cutting costs, they're cutting projects, which means that somewhere in the next 12 to 18 months, they will show profits. And by focusing on their actual customers that are producing growth, that themselves are focused on profitable opportunities. Yeah, I mean, there's nobody else that really does what Unity software does. So if you want to build very large universes, you want to work in the world of metaverses, you want to build, giant scale video games. Yeah, I mean, in my opinion, my judgment, Unity is, a company that you would have to, deal with. Anthony says, thanks for your continued insights into our portfolios. I appreciate your comments. Anthony Perry says, I'm confused in your podcast because I understood you feel like a top because your friend thinks, yes, in my opinion, we are at a top in terms of the S&P 500. Remember, I told you, like the S&P 500 is incredibly top heavy and very topped out. That you got Apple, Amazon, etc. But then you've got the vast majority of the markets, which are trading at 52-week lows or, at terribly low prices. People are, the nomenclature or the terms people use for for most people, the market, essentially they'll refer to the S&P 500 and think, well, all 500 stocks are like all at 52 weeks highs. This is not the truth. There's about 30 stocks that are at 52-week highs, or somewhere within 10% of it, and 90% of stocks are near their 52-week lows. Yeah, there's an extraordinary divergence in the market which has to resolve. So, what you call like the market and what, I'm talking about the market of stocks and you're talking about the S&P 500. The S&P 500 looks very topped out because the large companies, how much more can they grow? How much bigger can their stocks go up? How many more times price to sales can NVIDIA be at 100 times price to sales, 200 times price to sales, 5,000 times? What's the point at which sellers just come in and start to do that? And you can do that for pretty much all the large companies in the S&P 500. And you can do the opposite. What is Chewy's price to sales? 0.8. 0.8. 0.8, less than 1. Where do you want to be? 35 times sales? 0.8. I mean, you'd have to make those judgments, obviously relative to future growth, profitability, etc. But expectations are and sentiment is best measured, from my experience, by price to sales. In other words, very high expectations go with very high price to sales. Low expectations go with low price to sales. And in my opinion, you're at an extreme in terms of like the very top heavy S&P 500 and large companies, and you're at an extreme in terms of cheapness, lowness of the others. But you always tell us to have incredible growth in the same time frame. I'm not sure what the context is of your question. Every company doesn't have the same growth rate, and you know the S&P 500 or any index, you know, you're over time you're going to see obviously the bigger companies, the more successful companies get bid up in price, and at some point the price of the stock really starts to separate from the underlying business. In other words, the expectations keep going, keep going. I mean, we do not have a market in which things are just there. I mean, we tend to have big swings one way or the other as prices go up with our sentiment and how we feel. When prices are high, we will justify almost anything. You can believe and price anything into the future, and the reverse is true. At low prices, we'll believe any bad news that nothing can ever turn around, and we are sellers. And generally speaking, the big rewards come from doing the opposite. David says, made it for this live one. Need checking more often. No Indian food on the stove today. He's a big Indian food fan. Thank you for your comment. Tati says, should I sell my silver stocks or wait? I'm scared. Well, we've never recommended silver. And generally, I've, I think I did recommend one silver stock when I was at Banyan Hill a long time ago. But silver and gold stocks are in a bull market, in my judgment. Why? Because we're in a period when the central banks of the world have, after like bottling up the inflation genie for 40 years, they've let it out, and that means that anything that has a scarcity element to it, which is definable, or tangible, measurable, monitorable, is going to see buying interest and continuing buying interest. And generally, people tend to be the most fearful into bull markets and tend to be the least fearful really into bear markets. Why? Because a bull market is based on low prices and you fear that low price. A bear market is based on very high prices, and that high price gives you confidence. But like, I want to be in. And so as it drifts lower, you're like, but I want the old high price. So generally from low prices, you'll feel fear. Generally from high prices, you feel, greed, I suppose, or complacency from my experience. Mr. C. Matz says, it looks like inflation not going to go away quickly, so not sure the Fed wants to lower interest rates. So it may take more time for stocks to go up. I can wait. I have for 3 years now. So the thing is that from having studied interest rate cycles, there are up and down portions. Like this idea that we are going to solve inflation all at once, and we will not have interest rate cycles within a drift upward of inflation over time, is not borne out by evidence. If you go and study the 1900 to 1940 interest rate cycle, the 1981 to 2021, I mean, what it is like, there were recessions, there were periods when the Fed cut, there were periods when the Fed raised. It's not going to be just like all for one. In other words, this idea that we are going to wait to 2% and then the Fed will cut back to zero is not borne out by actual experience of how interest rate cycles run. So I'll say that in my opinion, what's going to happen is that we are going to see inflation track down, and as it gets to some point where we also see declining growth, and or we see one of the troubled industries that the Federal Reserve is like heavily involved in, commercial real estate is one, the banking industry, which has been destroyed by long-term bonds prices going down. And then the government. The government needs low interest rates as well. So when they have the opportunities to take rates down, they're going to look to do this. And then as inflation picks back up, they will lift interest rates back again. So this idea that we're going to have this like static, monotonic, it'll go to 2% and, we'll stay there. I don't think that's going to be borne out because there's always events and things that happen. Maybe it's, like I said, the banking sector, maybe it's commercial real estate, maybe the government, there's a currency panic, and who knows? So there's always events that cause things to move up and down. So a very static sense of the world, in my opinion, is not the one that is going to unfold. Am I familiar with ONCY? I am not familiar with ONCY, but the CY suggests that this is a biotech, oncolytics, maybe. I vaguely may know it from a very, very long time ago. Mr. CMAS says a lot of banks in the UK, US are in trouble, so maybe a good time to buy crypto, gold, or silver. Maybe there's a new financial reset if interest rates continue to stay higher. My study of interest rate cycles has shown that, generally speaking, the period of rising interest rates tends to be associated with more macroeconomic stability, and it's periods of lowering interest rates where you have the greatest amount of macroeconomic instability. And from what I can tell, the reason is that generally as interest rates go down, leverage goes up. And so people are taking on more and more risk. And generally as interest rates go up, leverage is being reduced. So you actually have fewer macroeconomic accidents of a certain kind, but you have like bigger sort of shifts going on. And you saw that sort of like from 1940 to 1981, where, yeah, I mean, obviously that's post-World War II. We go through two different currency sort of regimes with the dollar, deals made with all these countries. We go off the gold standard, all these different things that happen. And then if you go and look at from 1981 to 2021, I mean, there's so many different panics, usually driven around leverage, whether it be countries, companies, or the other. Next one, Apple stock is the same price it was a year ago. Yeah, Apple, no, I mean, it's today it is, but it has made marginal new highs from time to time, and that new highs keep people in. They keep people in. If you look at some of these old books from, I mean, I keep pulling these books out, but I've got two of these. Let me see. Where's the other one? Yeah. I mean, so if you go back to the beginnings of the market, right? I mean, this is a good question. Where is America going? I mean, this is, written in 1920. Yeah, 1920. The idea of distribution is to keep prices high, while insiders and people in the know, yeah, they distribute their shares out. I made this point earlier, which is that regular investors see high prices and it excites them, right? But remember, insiders, whether it be in management, whether it be folks who operate the markets, they're inside the market, right? They have far more information than you. They have far more access to whether it be demand and supply information about stocks. As we have seen, JP Morgan and other banks have inside looks on inflation numbers. I mean, in other words, this is sometimes rigged, sometimes manipulated, sometimes orchestrated system. And so very high prices being capped as a company can show no growth, essentially is keeping their price at a certain level by continuing buybacks at a certain level. The biggest insider, if you will, even though he's not an insider, Warren Buffett, is selling Apple stock slowly, but nonetheless, he's selling, right? This is like, by the way that old school markets, which focus very much on demand and supply and then wasn't built on theories, that's called classic distribution. And if you go and look, that is kind of what is unfolding with these very large companies, in my opinion. What do you think the catalyst for the turnaround in stocks will be when the Fed makes the rate cuts? I mean, the truth is that from my experience, low prices are the best catalyst. Low prices are the best catalyst. Why? Because from low prices, low prices, people are short. That demand drives things higher. And it's always something like, I mean, who expected that COVID would drive, obviously, a big surge into growth stocks, and then a big surge, like enormous surge into non-growth stocks, value stocks, etc. I mean, what was the catalyst? There was no real catalyst per se. In other words, the market shifted, and now we sort of like provide an explanation. But yeah, I mean, I don't know when rate cut. I'm thinking we'll see the first one come July or August. That's my best estimate, which is that that's when we'll see it, because the skepticism about it is now low at highs. People are talking about interest rate rises. Meanwhile, inflation has gone nowhere. There's definitely weakening signs in housing, cars. These are the two biggest parts of the legacy economy. If that's right, then there's definitely trouble brewing in the banks. There's definitely trouble, we know, brewing from commercial real estate. So that's my best guess. Has been with you since 2021. Tough road, but we're sitting on our hands. I appreciate your support and loyalty. Thank you. Any risk of Elon resigning if the vote does not go in his favor? What's Elon going to do? I mean, and what are investors going to do? I mean, they're going to make a deal in some way, shape, or form. Elon is at the heart of Tesla. If this deal doesn't work out, then maybe, I mean, some number of people, the stock will go down, some number of people will sell, and people are like, oh my God, we can't, I mean, we need to have Elon. And, he made a deal fair and square. He worked for it. He earned it. He deserves it, in my opinion. I voted for the deal. And, to the extent any of you care to do the same, I would say, it's not like he knew the future when he made that deal. He knew that things, I mean, nobody thought that he would ever make that money, which is why they gave him the deal. So he does everything that's needed, and now we're going to renege? I mean, it's un-American to me, but hey, we shall see what happens. What do you think about Sonova and Pat stocks? Sonova is a very levered, a new energy stock. I mean, they got a lot of debt. And so one thing about debt is that, it gives you operational leverage because you don't have quite as much stock. I mean, every company has to finance itself in some way. And so if you use debt, right, you get leverage, right? Because you borrowed all that money and then you put up all this plant, and as it generates sales and profits, those accrue to the shareholder. So in the upcycle here, you want to actually go and buy into leveraged companies because those will generate some of the highest returns that's out there. UiPath is again one of these companies that, I mean, it's not bottoming out. It's sort of like in that in between stage. That we had a period when some of these robotic stocks were being bid up. UiPath does robotic process automation, so it's I guess something that would be connected to AI. People haven't bought the stock, in the AI hype cycle here that's going on, but it's an actual company that actually provides a fairly large benefit that can be implemented pretty much by everybody. So I mean, we've held on to it for a while, even though the stock has mostly done nothing. Anthony says, do I have any predictions on how Tesla vote will turn out? I'm with you on this. If I am right, I mean, I think this discussion and debate has gone on for long enough that the people who don't believe in Tesla, I mean, why are you even holding Tesla stock? If you dislike Elon, dislike what he stands for, whatever, or I mean, obviously you wouldn't have a very positive view. And I know there was somebody, a fairly large investor that sold out because he disagreed, didn't want to do it. I think that, there in some way, shape, or form, a deal is going to be struck. And then, then we can go back to focusing really on the business. But either way, Tesla is also, it's also a new energy stock. I mean, so if I'm right, the bottom's been hit on Tesla, and Tesla is also one of the long duration, arguably the most important, along with Bitcoin, for the digital investment sector, the new world, if you will, of investments. Because Bitcoin's price is way out, the highest price is way out in the future. And in my judgment, Tesla's highest sales and growth and profits are way out into the future as well. So it looks, I mean, it feels, I don't know, it doesn't feel bad, but feels like a little dull. It feels like, like nothing's going on. But look, folks, I mean, that's often how like bottoms or low moments feel like. You feel like kind of like throwing in the vote and not doing anything, and see, what's going on. Yes, I actually had put PayPal and SQ as a sort of like a fintech, which is like sort of that middle ground with UiPath, where it's not bottoming out, it's not making 52-week lows, but I'm not seeing like momentum buying. The buyers are not showing their hand, but definitely after crypto, that's the next set, like PayPal, and we've got a bunch of others in across our ATG portfolios. Hey Liz, yeah, Liz says Elon's a genius. I agree. I mean, he's sending rockets into space and bringing them back and landing them on like dots in the ocean. Yeah, I mean, we are lucky to live in this man's time, in my opinion. I know Elon draws a lot of views, but I'm a fan. I'll admit it. But having said that, if Tesla stock, was not a good deal, I would definitely sell out and move on. But that's not my opinion. I think Tesla stock is low, in my opinion. Do I think Bitcoin has hit its peak for the year? Absolutely not. Absolutely not. If I'm right, we are setting up for an enormous surge that is coming imminently. I've said this on X multiple times. I look at Bitcoin's price all the time. You look at the halving, you look at the flows coming in from the ETF. No way. I mean, I would be very, very, very shocked if Bitcoin is not well into the six figures come year end. In my opinion, in my judgment, not a guarantee. Thank you, Liz. Appreciate you too. Thank you. And Derek says, hi, Paul. This request fair and benefit. Could you publish a list of all your predictions? Sorry, I don't even have a list of all my predictions. I haven't kept track, and I don't know anybody that does. If somebody wants to go back, I'm sure I've gotten a number of things wrong and I've gotten a number of things right. That is true for everybody. I don't think I can say like I get 99%. But one thing, whatever my convictions are, we bet, we invest alongside with that. And if it works out, you make big money. That is the end of the name of the game. If you follow any major investors, it's not like what you get right or wrong, but you take enough bets on goal for very large opportunities. You only need to get a few right. And then, your portfolio just rockets higher. I don't see any more questions, and we are at the 1 hour mark. So I want to thank all of you for attending this live stream. Check out ATG Digital. $9.99 is the silver tier. And I'll see you next Tuesday. This is Paul saying bye.